You work all month, and before that money even hits your bank account, a portion of it vanishes. At the highest levels of wealth, that automatic drain is largely absent. The math seems impossible. A person earning $50,000 a year hands over a significant percentage of their income, while someone generating billions in value can legally pay a lower proportional rate. These mechanics operate in plain sight, inside a parallel financial system built on entirely different foundations and complex loopholes. This disparity persists because the elite operate under an entirely different legal and financial framework than everyone else. There is a common assumption that billionaires have bank accounts overflowing with cash. Usually they do not. Their net worth is tied up in physical and corporate ownership. They hold shares in companies, massive real estate portfolios, and business investments. If a billionaire's stock portfolio increases by $5 billion in a single year, they are richer on paper. As long as they do not sell those shares, that growth remains invisible to the tax collector. By holding wealth as unrealized growth rather than taking it as income, they separate their true financial power from their immediate tax liability. The first step in this playbook is acquiring and hoarding appreciating assets. The goal is to accumulate equity, rather than climbing a corporate ladder for a higher salary. Trading hours for a standard paycheck triggers immediate taxation at the highest personal brackets. This explains why many high-profile CEOs take surprisingly small technical salaries, sometimes as low as $1 a year. The modern economy is structured to reward passive ownership far more than daily active labor. By substituting a traditional salary for company shares, the ultra-rich voluntarily step out of the income tax system that captures the middle class. If they avoid selling their stocks to prevent taxes, there's an obvious question. How do they actually pay for mansions, yachts, and private jets? They use a three-part mechanism known in wealth management as buy, borrow, die. Instead of selling, they use their massive stock portfolios as collateral to secure gigantic cash loans from major banks. Under current tax law, debt is not classified as taxable income. Banks are eager to provide these ultra-low interest loans because a billionaire's massive asset portfolio makes them a virtually zero-risk client. When these individuals eventually pass away, their assets transfer to heirs. Through specialized legal structures, these massive portfolios completely bypass the capital gains taxes that were delayed for decades. Debt is a burden that typically drains the middle class. The elite have engineered it into a vehicle for tax-free spending and generational wealth preservation. Even with these strategies, giant corporations and massive estates still carry some baseline tax exposure, requiring a third step: fortification. They use offshore tax havens and shell companies to shift profits out of high-tax countries and into low-tax jurisdictions. They deploy complex accounting tactics, deep depreciation, deductions, and intricate corporate structuring, executed by private armies of lawyers and accountants. For a standard wage earner, tax laws are rigid. For those who can afford legal architects, they are a flexible negotiation. These loopholes are structural features of the global financial matrix. For decades, tax codes have been drafted to prioritize capital, incentivize investment, and shield ownership. This creates intense public controversy. Some view this structure as a driver for essential innovation, while others see it as a mechanism for a rigged aristocracy. This outcome reflects a system performing its primary function, the preservation and growth of capital over the taxation of labor. The average consumer operates on a cycle of monthly survival and cash flow, while the ultra-rich think entirely in terms of long-term asset leverage. Millions of workers remain in a loop, earning a paycheck, spending to survive, paying heavy taxes, and repeating the cycle. Meanwhile, elite wealth grows exponentially in the background, quietly compounding and continuously multiplying at the very top, without any of their physical intervention. The ultimate divide between these two classes is the difference in the legal reality of how their money is penalized.